Accounts Receivable and AFDA Problem 3. Accounts receivable has a balance of $5,000 and the allowance for doubtful accounts AFDA has a credit balance of $450. The allowance method is used. What is the net realizable value of accounts receivable after a $160 account receivable is written off? The question's asking about accounts receivable, allowance for doubtful accounts, both challenging subjects, topics. We're going to make this a lot easier. What's it asking? What is the net realizable value of accounts receivable after? So we're told this question is all about understanding the rules, but also making sure you read everything in the problem. Net realizable value, NRV, is accounts receivable minus AFDA, the allowance for doubtful accounts. And remember that this can only be calculated under the allowance method. So accounts receivable minus allowance for doubtful accounts, that gives us the net realizable value. We're told in the problem that this company uses the allowance method. You wouldn't be looking for net realizable value if you weren't using the allowance method. Now remember, the allowance method is what's required under GAAP. Non-GAAP method is direct write-off method. We're not talking about that here. We don't have to go into the direct write-off method. Remember what the allowance method is all about. So the idea of bad debts expense, we understand that a business has to conduct business on credit terms many times. And the idea is that these credit terms where the customer can pay back money in the future, which is known as an account receivable, because if you're selling services or products on credit, then the customers have to pay you back in the future. That's an account receivable. We understand that all of these customers, they're not going to pay off what they owe. It's just normal business. The allowance method understands that, and it says, okay, well, at the beginning of the year or end of last year, you have to do an adjustment basically to estimate the amounts that you believe to be worthless with respect to those accounts receivable. What portion will not be collected? That's the idea. That's the allowance method. Now, other problems will go into depth on how to calculate that estimate. This question, we're given the amount that's written off, as well as the account receivable balance and the credit balance in AFDA. So we're told that accounts receivable, $5,000. That's given to us in the problem. Has a balance of $5,000. That's a normal positive balance. We're not told, but we assume that specifically it's a $5,000 normal balance. We are told that there is a AFDA credit balance of $450. Now remember DEALOR, DEALOR. That's one of my favorite acronyms to use. And the idea here under DEALOR, this acronym, is the D is for drawing, E is for expense, A is for asset, L is for liability, O for owner's equity, and R for revenue. So A, asset, is over here on the left side, debit side. The LOR is the right side, credit side. The A in DEALOR, assets increase on the left, the debit side. Accounts receivable is an asset. AFDA, what kind of account is it? It is a contra asset, because the idea of AFDA, allowance for doubtful accounts, it's the allowance we use to write off these respective accounts receivable, so it's a contra asset. Contra just means opposite. So whatever opposite side that the normal account increases on, this will be the opposite. So a contra asset will increase on the credit side using DEALOR. It's the opposite. So AFDA increases on the credit side. We're told there's a credit balance. That means it's positive, and we can subtract that away. $450. We get an NRV of $45.50, and you think you're done, but you're not really. We're told after writing off $160 account receivable. Now, under the allowance method, as I mentioned earlier, at the end of each accounting period, end of each year, which rolls over to the beginning of next year, we write off a portion of we estimate the bad debt expense for the year. We write off the accounts when they're written off specifically to show which accounts are written off for each respective customer. If I said that earlier that we write off the accounts, I meant we record bad debt expense. We record an expense. We write off the accounts when we know they're going to be worthless at that time for timing purposes. We're told that we are writing off $160 account receivable. That isn't part of the estimate entry. That is the actual write-off. So the estimate entry happens at the end of each year to calculate the estimate in that bad debt expense in that allowance for doubtful accounts. So we're going to debit bad debt expense, credit the allowance, the AFDA account at that time. When it's written off, we then go to our allowance account and a little bit comes out of that. We reduce it. We reduce accounts receivable by crediting accounts receivable, reducing accounts receivable. So we're going to subtract away 160. So when we subtract away 160 of accounts receivable from accounts receivable, that means that it's being written off. That brings our new balance of accounts receivable to $48.40. AFDA, which again, at the end of each accounting period, we fill up the bucket of allowance for doubtful accounts. It's an estimate. Think of an estimate like a bucket. You fill it up at the end of the year, and then whenever you write it off, you use a little bit out, you spill a little bit out. So that 160, we're going to subtract that away. We're going to debit allowance for doubtful accounts. We're going to subtract that away, and that brings our balance in the allowance for doubtful accounts to 290. Now, NRV is still, we subtract away these numbers, and we get 4550. And 4550 is the end answer. Yes, I know we got it earlier. We got 4550 here, but that was not the correct calculation because that was before taking into account the $160 of account receivable that's written off. 4550 is the correct answer, and here's the proper calculation. We're done with this one.